Julian Emanuel's with us, Evercore Senior Managing Director with us at Post 9. Good morning, Julian. Good to see you again.
Great to be here.
You do note that the earnings rally that we got in May was historically a blowout, as you call it, yes?
Massive blowout. And look, if you think about how incredibly apocalyptic the bearishness was at the April trough, record volumes, record bearishness, record volatility, it's not a surprise that earnings as good as they were, and again, part of this is the front loading against all the tariffs and whatnot that we're seeing, that you got that type of reaction. But when this has happened in the past, it tends to be a time for the markets to pause the rally that, again, is more than 20% from trough to peak. And when you throw in the uncertainty around policy, it makes an even more compelling case at 23 times earnings for a pause in the rally.
Does it mean we don't need to revisit the lows?
We don't think you do. We do not. So if you think about the things that end structural bull markets, and we resume the structural bull market at the April low, that AI had 2 years of runway, and we think there's going to be further runway. But we don't think there's going to be a recession. Ed Hyman and his team has never called for a recession. We do not believe there is one. And as we've seen, the policy tends to, let's say, evolve when we get down to the lows. But we don't think you need to go back there. We just think it needs to be sort of one of these healthier periods where we get more clarity around policy. Because, look, let's face it, that court ruling Wednesday night essentially took the globally weighted tariff rate down to 6%. And then we heard about more friction with China. And then we heard about steel and aluminum tariffs on the EU. And as you pointed out, Canada is also in the crosshairs. And that takes the rate to a more uncertain level, likely over 10%, probably closer to 15%. And they will, as the president has said, find workarounds if the courts rule against them.
They do have options on that front.
Lots of them.
What about, okay, so one of the big risks, the sort of overhangs and the clouds, has been this idea of stagflation. We might get a inflation flare up at a time where growth is slowing. But I just showed you Supercore going negative. There are a lot of reasons to think we might not get that in inflation. How do you assess that risk?
Well, let's step back and say that the batch of numbers that we just got at 10 a.m. were reasonably stagflationary sounding. That having been said, we felt all along that there's this push-pull between growth and inflation such that, you know, if you look out the next few months, those inflation numbers are likely to be elevated. But the one thing that we've seen is that the labor market has not yet broken. We don't know how significantly it's going to break. It could well be that there's resilience there. But either way, you get that inflation bump. It's likely to cool demand enough so that it becomes sort of self-regulating.
So the Fed should cut?
Well, our view is the Fed will cut twice between now and year end.
That's where the market is.
And potentially, once we get through this latest round of policy uncertainty, and of course the big beautiful bill is part of that as well, because literally every outcome that you can think about with the big beautiful bill is probably going to put a floor under long-term yields, then it's time to cut. But not until there's more news and further progress over the next several months.